So it was just after Liberation Day, about a week or so after Liberation Day. And we were talking about, well, the delayed impact, when does it come? And at the time you said probably the first signs are going to be July. And well, here we are in August. And you tell me, it feels like we're seeing those signs, right? It's like, oh, look at the Walmart prices, they're up. And look at, there are these little areas where you're starting to see the impacts. I mean, fresh vegetables. That is something I think folks didn't fully appreciate, that how badly that was going to get impacted by these tariffs.
Yeah, you can see it in the data. We got a data point for producer price indicators at PPI indices, producer price indices. Remember, I always say PPI. I never really spelled out what that is exactly.
I appreciate you trying, because as I always say, we want to speak American on this podcast.
Yeah. PPI. That's what the prices that businesses charge each other, right? Before it gets to consumers. And so it's kind of a leading indicator for consumer prices, the prices we pay, you and I, when we go into the store. And they jumped in July by a lot, so it's coming. And even in the consumer price index, the CPI, the one that we all kind of know and love, you can see it, you can feel it. I don't know that, if you ask Americans, can you feel the tariffs, that they would say, yeah, I feel it. But you see it in the data, and all the direction of travel here suggests this is going to continue to be the case. And I think, if you invite me back in 2, 3, 4 months, we'll be able to say definitively Americans are feeling it.
There's been a lot of coverage over the last 3 or 4 weeks about how, hey, the predictions of doom and gloom on the tariffs haven't come to fruition. And I'm thinking, why are you writing this story now? It's too early to write this story. Is it, or are you, or is it surprising that the hit isn't harder yet?
It's pretty much the script. I never thought that the tariffs and the other policies that are being pursued, like immigration policy, would be what I call a cliff event. That we go off a cliff. That's immediate recession. I always thought it was more of a corrosive on the economy. But when the economy is under such pressure, and it is vulnerable to anything else that could go wrong, and thus recession risks, in my mind, are very high. But no, I think it's stuck pretty much to script. I mean, there are a few things that have slowed down the pass-through of the tariffs to consumers. All the so-called front-loading that went on.
Inventory front-loading, right?
Yeah, President Trump has kind of telegraphed very strongly that he's going to raise tariffs, and so importers have been working hard to get product into the United States before the tariffs actually are implemented. And we're still working down that inventory. So it won't be until you get to the other side of that you start to see the real price increases.
If you watch a TV ads, I think it's for Kia, could be Hyundai. It's one of the two Korean car companies who brag. They say in their advertising, we're not passing on the tariffs to you. And I'm thinking, yeah, because you already brought these cars over before you had to pay the tariffs is my guess. But I thought, well, good for them for the marketing, because they know people are thinking about those things when it comes to buying.
Well, they're in the political spotlight too, right?
I mean, a Kia or a Hyundai.
There's a big shiny light on them, I think though with the foreign producers, we'll start to see more of the price increases with the shift over in the model year. That's when we're going to get the model year changes over, and that's when they generally put in price increases. So we need to watch that very carefully. And
we're right at the beginning of that process.
Right at the beginning. Yeah. Generally, it's kind of August, September, right in there. So we'll see.
So are the conditions there for an interest rate cut? And is it a necessity, or is this something that it's probably being done with a little political pressure?
Even without political pressure, probably a cut is warranted. I mean, the other aspect of the tariffs, when you ask me, am I surprised, is growth. And there, the economy's growth rates have really slowed very sharply, in significant part due to the uncertainty created by the tariffs, but also the tariffs themselves. And you can see it in the job market. The job market is really throttled back. I mean, underlying monthly job growth is, 20, 30,000 jobs. I mean, that's nothing. And you're right on the border of a negative number. And I think we're going to get some negative numbers here. So if you're at the Fed and you're looking at that, you're saying, I'm going to put more weight on what's going on with respect to growth in the economy than I'm on inflation. And then you put the political overlay on top of that. Think about if we actually go into recession, what will happen with regard to the Federal Reserve. There's a lot of, obviously discussion about Fed independence. There's some talk in Congress about a piece of legislation to change the Federal Reserve Act of 1913, which would further impair the independence of the Fed. So if you're sitting at the Fed, the last thing you want is an economy going into recession in that political context. Right. And so they're weighting very heavily growth over inflation at this point. So therefore, I'd be surprised if they don't cut rates when they meet again in September.
And that should provide some impact in the economy. At least, that's the hope, right? That it triggers some investment, maybe delays planned layoffs. Is that
on the margin? This rate cut is well anticipated. I was just looking a few minutes ago. The market's
code for priced in, right?
Priced in. It's priced in. 85% probability that the Fed's going to do this in September, cut rates, and then cut rates on a consistent basis going forward until they so-called normalize rates, get rates down to something that probably closer. Right now, the federal funds rate target's just over 4. If you get it down closer to 3, that would be consistent with what they think is what they call equilibrium, where policy is not either supporting or restraining growth. And that's baked in, that's discounted, that's in the stock price, in stock prices and credit spreads and everything else. It does help in the sense that, some interest rates that, that matter to consumers and businesses will fall. So for example, if you owe money on your credit card, you should see that rate. That rate is extraordinarily high. It's over 20%. It's close to record high. That should come in. If you have a home equity line of credit, you should see pretty quickly a cut in your interest rate on that loan. If you're a small business person and you have a loan from a bank, it's usually tied to the so-called prime rate, which is tied to rate. So there are some benefits if you're a borrower, but most of the benefit is already baked in to a significant degree because investors already have anticipated what the Fed's going to do here.
So when you look at the state of the economy, let's start with employment. The current, what's a little bit scary, it's like, so we have multiple things happening. You have this cut in government, right? And you have this pullback in government funding to the states, which is going to have a follow-on effect, right? If we've seen federal government workers laid off, you're going to probably see state and local government because there's a whole bunch of money that the federal government had been helping states with. And we know the state budget crunch is coming. Essentially, the next legislative sessions around the country are going to be filled with a lot of tough choices because they've had a lot of free money, COVID being a big factor here to do that. So you're going to have on the government sector side, a shrinking of the labor force. Then you also have the issues that are associated with tariffs and the cost of things. So if fewer things are coming in, maybe you just have fewer workers in general dealing with your, and then you have the investment, all of the AI infrastructure investment, which doesn't actually create jobs.
Right.
So I look at that and think as an amateur observer that's probably a little overly informed and think, boy, this is a tough job market that's likely to get tougher in the next couple of years, given where investments are going in corporate America. What do you see, and what are you watching to see whether this sort of jobs Armageddon that may be coming for pink collar America is coming?
Yeah, I agree with you. I think it's going to be a tough job market. Just a question of how tough. Whether we start getting negative employment numbers here. Actual outright declines in employment. I think that's a real possibility. The other way of you framed it very nicely. You kind of went sector by sector and said, where the jobs going to come from?
Where is their job growth?
Right? Yeah, exactly. And that's one reason to be very nervous here. The only industry of consequence that's adding significantly to payrolls at this point is healthcare services, hospitals, doctors' offices, that kind of thing.
So our aging population creates jobs. Great.
Yeah. And some of that feels like catch up because the healthcare sector was slow to hire coming out of the pandemic for lots of reasons. Sure. But now they've caught up, and then you got to ask yourself, will the healthcare sector continue to create jobs to the degree that it has? And then you throw in all the other things you just said. The thing I'd throw into the mix is immigration. We're seeing a very sharp now decline in the immigrant labor force, and so obviously that's fewer jobs in construction trades, agriculture, manufacturing.
Well, is that fewer jobs, or is it just fewer jobs that'll get filled? Right, that's the question I have. If those folks aren't there, and what happens to those jobs?
Yeah,
what happens to the chicken processing plants, for instance?
Right, exactly. Right. It's not like those positions are going to go away; they just can't fill them. They're just not going to fill them. So it shows up as no job growth when you would have expected some job creation in the construction trades or leisure hospitality or whatever it is, and you're not going to get it because you just don't have the bodies. You just don't have the workers. The other way of thinking about it is, or framing it is, hiring and layoffs. There's no hiring. Businesses writ large, pretty much across the board, healthcare being the exception, they just aren't hiring at this point. And that may go to the uncertainty created by policy. They're just nervous about what it all means. It could go partly to AI and the impact AI is starting to have, because a lot of the lack of hiring is in professional services and financial services and sectors where you expect AI. It's not like they're laying off yet because of AI, but they're not hiring because of AI.
Well, let's put yourself in the shoes of a CEO wondering if AI can create efficiencies. If I were running a small business or medium-sized business, and I wouldn't fill positions as needed yet. Right, I'd see, hey, what can we do with AI? Right, I wouldn't be laying people off, but I mean, that what you're describing is sort of like a very logical way. Like, let's see if AI can fill the gap here, and if it can't, okay, then I'll hire. But I'm going to wait maybe 6 months, to see how good these tools are and whether this really is a replacement level technology in the moment that we're living.
Totally. I think that's now small businesses, they have less latitude to do that. I think because there's just less room to maneuver. Right. But bigger businesses, absolutely. The largest employers in the country, absolutely. That's, I think, the way they're thinking.